Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
In this segment, we're talking about using a home equity strategy in the home equity conversion mortgage, really an equity line of credit with popular platform speaker, author, and adjunct professor at the American College, Don Graves. Don, I am pretty schooled as an advisor on the traditional, it's HELOC, right?
Uh-huh.
The HELOC loan, okay? Traditional. If I want to go to equity line of credit, I go to my bank, I show them my mortgage, they do an assessment, they tell me here's a checkbook, and you have to pay at least the interest every month, and see you later in 10 years. I might have to come after you in 10 years, and you have to have it all paid off.
Sure.
And on top of that, they have the right, if they wanted to, they could close the whole account down, and I hear it's not backed by any federal government in that. That has nothing to do with FDIC.
Right.
Okay, just make sure I got the numbers right. Okay, so that I understood. When you introduced the Heckam version of this, I was like, how can that be true? I mean, I was surprised. Talk a little bit about, and I can only entitle it or give it a name, an appreciating line of credit that has no correlation to the market value of my home. How can that be true?
My family's from Falmouth, Kentucky, and even in Falmouth, on the side of our house, if you went out there, you'd find this thing sticking out the side of our house, and you'd hook a water hose up to it, and you'd turn it, and water would come out. That was called a spigot. I don't know what you boys call it here in Arizona. But I said to someone, what if there was a way that I could turn your home into something? And I'm going to bring a spigot, but we're going to put it right here under your kitchen light switch. And when people come in, they're going to say, wait a minute, you've got a spigot. And you'll say to them, wait a minute, be careful with that. And they say, why do you have a spigot under your light switch? They say, I'm going to show you. Say, go over there and get that bucket and put it under that spigot, but turn it slowly. But as they turn that spigot, instead of water coming out, money came out. And the client and the person said, don't go too fast. They said, what in the world is that? They said, I turned my home into a reverse mortgage line of credit. And you say, what? That's right. A reverse mortgage can be turned into, you can have the money when you get a reverse mortgage. Let's take a $400,000 home and the client qualifies for $200,000, just using our 50% example. Now, you can have that in a lump sum under certain circumstances. There are some throttles on that this day. You can have it as a monthly payment, or you can take it as a line of credit. You know what a line of credit is. It's just a credit card. You have access to the money. You don't have to, it's not accruing interest until you use it. And that's what we're talking about. Now, what's different about the reverse mortgage line of credit? I call it a RELOC versus a HELOC, which is your standard line of credit. So you've got your HELOC and you've got your RELOC, the reverse mortgage. Now, your standard home equity line of credit, you go down to the bank, you set it up, Steve, and you have $200,000 in there. And 10 years from now, if you haven't used it, it's still $200,000. But with your RELOC, your reverse mortgage line of credit, you set it up for $200,000. It's got a guaranteed built-in growth factor, 5.5% today. So that means at the end of the first year, it's grown by $11,000. You've got $211,000 in there. The next year, if you didn't use it, it's $222,000, and then on and on. And guess what happens? It keeps going up. Well, Don, what if my home value went this way? It grows irregardless of the home's value. So the question is, who doesn't need a backup plan to their retirement savings? Who doesn't need a plan B? Who doesn't need a what-if fund? And let me use my Kentucky analogy. Who doesn't need a spigot in their kitchen underneath their light switch that when you turn it, money comes in? But the unique thing is not only is money coming out when you use it, money's still coming in on the top. It's the most significant thing. Now, that's my Kentucky analogy, but the Journal of Financial Planning that advisors use, and maybe your advisor, began to write about this in 2012. The article that changed the world was called Reversing the Conventional Wisdom. For years, it was said, Well, don't only use the reverse mortgage as a last resort. When you've squeezed your last dollar so tight that the eagle is screaming on the back. And what they found out that's the wrong way to do it. Just recently, just a few months ago, big research paper came out and said there are 5 ways you can use a reverse mortgage in retirement. The 6th way is to use it as a last resort. They said that's the worst way to do it. The 5 other ways were to use it first, use it as a 10-year payment, use it as a line of credit where you get it and you pay it back, or the number 1 way, Steve, was to get a reverse mortgage on the onset of your retirement, set it up, don't touch it, and let it grow. And it was not me. The financial thought leaders across the country all agreed, because there was math and science to say this is the best way to use it.
Okay, Don, I just want to review just to make sure I got this right. So I have an appreciating line of credit that is not connected or correlated to the market value of my home. Did I get that right?
That's absolutely right.
Okay. Now, let's say I took I have some money that I'm using on my line of credit, but the rest of it still has an appreciation factor. Is that correct?
That's right. The unused portion is always going to grow.
Okay. And I am under I just want to make sure I got this right. I'm under no obligation to pay any monthly interest like a traditional line of credit.
There's no monthly mortgage payment required on that.
Okay,
Use it. You can even repay it. Use it as a revolving line of credit. It's a powerful tool.
Now, I just want to make sure I got all the mechanics here. There's no 10-year limitation on this like a conventional line of credit.
Right.
The bank or institution, or in this case, HUD, can't come back to me, right, and decide they're going to close out the account.
That's right.
Okay. Unlike an equity line of credit in a traditional bank institutional scenario, this actually has insurance behind it. Is it the FHA or HUD? Who's behind that equity line of credit from an insurance point of view?
Sure. The Federal Housing Administration, which is part of HUD, is insuring this loan. Now, what do they insure? They insure that and this is on every reverse mortgage, that you'll never be required to repay more than the home is worth. So the scenario is a person has a $200,000 reverse mortgage and they take it all out and they buy a boat for whatever reason. Now, 10 years later, they may owe $300,000, but their home is only worth $200,000. So in that case, you owe more, $300,000 more than the home is worth. Under normal circumstances, if you had a traditional mortgage, they're going to file a deficiency judgment against you, your heirs, or your estate. Under the HECM, the Federal Housing Administration, ensures that. So neither you nor your heirs will be required to repay more than the home was worth. No deficiency judgments taken against you or your estate.
I just want to make sure I understood this. So there's no shortfall, payment due, no penalty for it.
That is correct.
Wow, I think that's huge.
It's absolutely
That's huge. Okay. So now we've walked through some of the basic differences between traditional line of credit and this. I have seen, and of course, it shocks me that people actually are taking this and buying a boat with it. I guess if you said it, it shocks me. We're trying to make a nice retirement here. I don't know how nice I want to make it.
Sure.
Right? But when I've got my credit on, I like the idea, and I do love this as a planner. I love the idea of having a reserve cash account that how quick can I get to it? Write a check.
Sure.
I mean, that's what you're telling me, right?
Sure.
All right, so I have this cash reserve. Now, a lot of our seniors, and this is where I think this could come into play, they've been they've been frugal, they've been very good about their money, they've been very good stewards. Now we start getting your 80s and 90s, we're starting to have issues, medical issues. Some of this Medicare cost we'll take care of. Some of my long-term care maybe gets taken care of by some contract that I might have or a policy I might have. But most of the time, I'm running into people in their 80s, they're having medical issues.
Right.
And they need to figure out a money. It's going to be greater than whatever Medicare is going to take care of. Some of this other stuff is going to happen. This is a huge issue because I think you need money later in life, not so much in your early retirement. I think you need it later in your 80s and your 90s.
Sure you do.
Talk a little bit about your experience about this line of credit and how much it's been really a saving grace for our seniors that are in their 80s and 90s.
That's the term that Forbes magazine used last year and earlier this year. The saving grace is the reverse mortgage line of credit. Steve, it allows, again, you set it up early. You let it grow. Now you've got this big piggy bank. How many things do you have as a retiree that's growing at 5.5%? Very few people have that. Now, you're later in life, you've got this big pot of money, and you've got health concerns, you've got other things, and now you've got this huge reserve to be able to draw from and supplement that. And it's proceeds from a loan, so it's not countable for Medicaid purposes. So You can.
That's huge.
I won't get into that right now, but that is absolute. If someone says, Don, mom may have health issues down the road, I said, set up a line of credit today. I said, because if dad's still in the house and mom has to go into custodial care, this line of credit is not counted as a countable asset. So dad can turn that into cash flow. He can use it to supplement his needs, whatever, without impacting mom's qualifications for getting into some sort of SIP.
Well, remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our fifth segment, we're going to talk about how to use the home equity conversion mortgage in retirement planning with Don Graves. We'll be right back after the break.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.